Hey there, it is Corey here, founder and advisor at Verse Wealth, and thank you for joining us for this market and economic update. Well, it turns out that rising inflation, rising interest rates, and a sprinkle of war aren't a great recipe for investment markets. It's been a very bumpy, to say the least, start to 2022. We've got the Aussie market, the All Ordinaries, that's our top 500, down about 9-10%. For the calendar year so far. US market, S&P 500, down closer to 20%, and the NASDAQ, the US tech market, down almost 25% so far this year. So to kind of cut through all of the noise and the commentary and the headlines and the uncertainties and some of the worries, of course, as well, we've invited in Tom Schubert, one of the founders and managing director at Drummond Capital Partners. Tom, thank you for joining us, mate.
Thanks, Corey. Great to be here.
Lovely. Now, just before we dive in, not everyone's going to be familiar with yourself, Tom, and Drummond. So give us the quick rundown on who you guys are and what you do.
Thanks, Corey. We're a multi-asset, multi-manager business, and our expertise is really asset allocation, getting that right mix of assets for diversified portfolios, which we manage on behalf of financial advisory groups such as Verse and your clients.
Lovely, thank you. So let's jump in. So I mentioned markets are down a long way, and that's on the back, I must say, of a pretty solid run up on the back of the COVID-19 lows in early 2020. But given these falls that I just mentioned, can you kind of give us the story or the synopsis as to kind of what's been the catalyst for this downturn, and what are the factors that are kind of having the biggest influence on markets?
Yeah, look, it's a great question. And look, whilst the headlines have probably been dominated largely by the Russia-Ukraine war, the major driver in equity markets has really been a dramatic shift in the outlook for interest rates as a result of sort of higher and more persistent inflation. The war compounded these issues because it pushed up commodity prices, particularly oil, and interest rates essentially affect the valuation of all asset classes. In simple terms, higher interest rates equals lower valuations. And so really, last year we saw inflation kind of continuing to rise, and for a long time, the general narrative was that it was going to be transitory. That was the word du jour used by central bankers. And when they got to the end of last year and realised that it was continuing to rise and not passing, but more importantly, broadening, we saw a really dramatic sort of backflip in their outlook and interest rates, market interest rates initially. So the pricing of forward interest rates start to move higher and dramatically. And that's really caused largely the volatility we've seen this year.
And if we could just kind of dive under the hood there a little bit, because like we all get that interest rates have been at record lows and they're now beginning to rise in the US. Here, we saw our first rate hike in 11 years only a couple of weeks ago. You mentioned that rising interest rates affects valuations on stock markets. Like, why is that actually the case?
Essentially, if you think about, we think about valuation. One, we've been through a period of just declining rates now for a long, long time. So I guess we haven't really had to face the prospect of rising interest rates and what that means on valuation. So people are adjusting to this. But essentially, the valuation of an asset today is the present value of all the future cash flows, think profits, earnings you can earn from that asset over time. And the further out into the future those cash flows are, the more sensitive you are to the sort of today's interest rate, because we discount those back using a market interest rate today. And that's why things like technology companies have been more sensitive, because essentially they may not even be turning a profit for the next few years. All of their profits and upside comes out in the future. And so they're even more sensitive to higher interest rates today, which is, you mentioned the NASDAQ being down a lot further than other markets.
Well, to that point as well, because I think that tech's had such a great run, and big tech's had such a great run for such a long period of time, and I don't think the long-term theme is over. It's not by any stretch, but I think there's a lot of people with portfolios that are probably hurting at the moment, given the tech exposure, and probably a lot of people that have invested perhaps solely just in tech as well. So with that in mind, tech's come off 20-25% broadly. Do you perhaps see more pain there to come? And, is this now, or is there potentially coming a longer term buying opportunity for some of these kind of big tech companies, for people that are, that way inclined?
Absolutely. I think there's, again, two main factors driving the big sell-off in tech. The main driver being interest rates, as they have a higher valuation. We spoke about the more sensitive to interest rates. So that's been the big driving factor. But the other one was sort of COVID. If we think about the setup, it was such an unusual economic event with the world economy essentially in lockdown. The only real winners were technology companies that helped us, shop online and work from home. And so this brought forward a huge amount of demand for these companies. It's fair to say if you didn't have a Netflix subscription during lockdown, you probably never will. And actually, interestingly, in the last quarter, Netflix, for the first time in its history, reported a decline in subscription. People are turning off the TV and going back out in the world. It's good news for society, not so good for their earnings. And so partly it's earnings driven. I think the market adjusting to what is their normal pace of earnings now that sort of one-off COVID, lockdown event has passed. And the other thing that happened during COVID and 2020 in particular was a real focus on what's going to be the next big tech winner from pandemic and work from home. And so there were lots of amazing stories and concept stocks, which just, had explosive sort of share price growth, but have really failed to deliver any earnings off the back of it. And so those companies have really been punished. So in a way, I think the market's been quite rational. We've seen the valuation of the quality businesses, the Microsofts, Amazons, Apples of the world decline. They got to probably a little bit overvalued, it'd be fair to say, last year. And so we've seen interest rates rise and the valuation of those companies come down to levels that, in our view, start to look pretty attractive. They're still great businesses. This is not the 2000 tech wreck. These are amazing businesses that we all use every day in our lives. But then, rationally, we've seen things like a Peloton, which is an exercise bike with an iPad strapped to it, which was trying to masquerade as a technology company, fall, say, 80%. So these are pretty rational responses in the end to sort of what's going on in the world. So, to your point, I think there's maybe a little bit more to go on this front, and people have had their fingers burnt. So it might take a little while for tech stocks to stabilise, but certainly on a long-term view, we're starting to trawl through and look for potential opportunities there.
Yeah, I mean, as you're talking there, I'm thinking about the concept of FOMO, that fear of missing out, and I think that has certainly been a theme in investment markets in the last couple of years, and in tech stocks when you're looking at some of the returns on the NASDAQ and some of these big tech companies, and like you said, some of the smaller tech companies that aren't even turning a profit yet, and they're more concepts, and they don't have market penetration, like they don't have a real business just yet. And some of those stocks, and I've spoken with people in recent weeks that have held some of these stocks, and they're down 50, 60, 70, 80%. So there's a lot of speculating going on there, which is something very different from investing. And I was thinking, again about that Warren Buffett old quote of, it's not until the tide goes out you actually realize who's swimming naked. And that's
absolutely
we're seeing that at the moment in investment markets, and we're seeing that with cryptocurrency as well in recent weeks, and the major kind of sell-off and collapse with a lot of those currencies as well. So with that in mind, I mean, I guess what you're saying there is, we have this significant, that's an understatement, an unusual event with COVID-19 and what effect that had on economies globally, and how kind of governments and central banks responded and pumped a lot of money into their system to kind of put a floor under it and keep things going. And then kind of, it's almost like we're feeling the after effects of that now. It's like, we've got the hangover now. So rates came down to nothing. They were there for quite a while. A lot of money was put in the system, and all of a sudden now we've got the rising inflation, which isn't a shock. We're just hoping it wouldn't be as aggressive as it is. And now we knew rates were going to rise at some point, but they're rising sooner than expected, more aggressive than expected. And I think it's not so much the concepts that we have inflation, the concept that we have rising rates. It's more so the concept that these things are happening faster, more aggressively than anticipated, and markets are adjusting to that element of the surprise. Is that fair to say?
Yeah, absolutely. I mean, we live in a world now where news flow moves fast, and so things, get priced in. Changes to outlooks get priced in, much more swiftly than perhaps previously. And secondly, initially because of the pandemic response, I think policymakers panicked, like everybody panicked about a global pandemic, and they went really hard on both on the fiscal side, cash handouts, JobKeepers type policies, but also on the interest rate front, just zero rates everywhere in the world and lots of money printing, quantitative easing. And so the combination of those two was incredibly powerful and ultimately successful, right? I mean, we ended up with an economic boom and a stock market boom off the back of it, and we have full employment, which is a really swift recovery from a deep recession. And so that's a good thing. But as you say, now the hangover is, we need to take the punch bowl away, and the economy needs to find its level without the stimulus from governments and with a more normal interest rate. And that sort of path of readjustment is a rocky one.
I've noticed in recent weeks that there's increasing talk about potentially looming recessions in the US and elsewhere. And I read a stat yesterday in the Financial Review, which was that of the last 14 times the Federal Reserve, so that's the central bank in the US, that's their version of the RBA, has raised interest rates or started raising rates. Of those 14 occasions, on 11, the US has had a recession that has followed. So perhaps maybe just shed a bit more light on that, and also perhaps just talk more generally around what the recessions tend to mean for markets. What might it mean for this market? Do you see a recession coming? And and are these things people should be spooked by or just conscious of?
Yeah, look, really good questions. In the 3 occasions that they avoided the recession, what they were able to do was sort of backflip or pause on hiking rates. The last one was actually 2018. If you remember, they had a really slow interest rate hiking cycle in the US, which actually commenced in 2015 and was, it was like watching paint dry. It was 0.25%, then 0.25%, and then finally it sort of started to ratchet up a bit more quickly in 2018 and caused a big sell-off in the end of 2018. And then they backflipped, started 2019 and started to ease policy again, and the economy never entered recession. They were able to do that because inflation was not a problem. And so the only times they've engineered hiking cycle without a recession has been in times where inflation wasn't a problem that they had to get under control. So we can understand now why people are increasingly worried about a recession. The question on this is perhaps not if, but when. And that matters a lot from the market's point of view. Like if we are able to go through a reasonably steady hiking cycle, the economy is pretty full. Households are in good shape. There's plenty of jobs, particularly in the US. They should be able to tolerate higher interest rates for a period of time. The equity market obviously needed to make its valuation adjustment, but the real economy should be able to tolerate. It's only gone, it's not even at 1% yet. So it should be able to tolerate interest rates moving back towards that level without, complete shutdown. And so maybe the recession is not until 2024, for example, in which case the S&P down 20% represents a pretty good buying opportunity here, because that is consistent with a big correction outside of a recession. If for whatever reason inflation they were not able to get under control quickly, if we don't start to see that moderate, and we can maybe talk a bit more about that as well, but they need to keep hiking rates much more rapidly, and it does, bring forward a recession, say to 2023. Well, the equity market may start to want to price that in the next quarter or two, and so on average peak to trough decline in markets during a recession is sort of 30-35%, and so at 20 we've done a lot of the heavy lifting. You'd argue there's only another 10%, which look, it's not great. But it's also, we're further to the bottom than we are to the top, given even a recession scenario. And given that that's not exactly, it's not locked in that that's going to occur, again, we sort of urge some caution. So everyone's got very concerned. And really, we think the only way to go lower now is if we are actually going to price in a recession, which, it's, again, not necessarily around the corner.
Yeah, and to that point as well, I think for most people out there, when they hear the term recession, instinctively they think that share markets are going to drop substantially at that point when an economy moves into recession. But that isn't always the case. And if we look back to COVID, and markets fell here and in the US by 34% in basically 30 days, from late Feb to late March, and this was kind of just before we fell off the economic cliff.
Yeah.
And then markets rallied so aggressively off those March 20 lows. Meanwhile, economically, we were in the heaviest recession that we had ever seen.
That's right.
Yeah, markets were, putting on double-digit gains within months. So perhaps maybe just talk generally, if you can, around, I guess, that distinction between the economy and investment markets, and the fact that, and the reasons why they're not correlated in terms of how they move together.
Yeah, sure. So the equity market, financial markets are a discounting mechanism for the future, and so they tend to price what's going to happen ahead, not what's happened in the past. And so we are looking forward to the next year and saying, well, what does that mean for corporate earnings, and what price are we prepared to pay today? And so in a way, they often lead the real economy with a lag. So exactly as you said, it's quite unusual. People are sitting in this horrible sort of lockdown recession, yet markets are making new highs, and they can't quite discount that. Well, that was what happened in March 2020. Was the market priced in what was going to occur, and it subsequently occurred. And so, in a way, it's important, right? Because it can often bring you unstuck as an investor, because once you're in the recession in the economy level, you might be panicking and thinking that means you shouldn't be in, your investment portfolio as well. But largely that's in the rearview mirror. So what we're interested in from here is, if the market goes on to discount that recession in the price, so that maybe it does fall a bit further, if we think that that's then baked into the price, that's a great buying opportunity for us, because either it's going to happen and we're getting compensated for that in the price we pay today, or even better, and it doesn't happen and markets are just outright cheap. And so we're always trying to think about what is the probability of an event occurring, and is it actually already captured in the price today?
Yeah, well said. It comes back to that adjustment relative to what the expectations are.
That's right.
Rather than exactly what just happens as well. So, and as I said, COVID-19 was no better example of markets and the economy, being in different states at the same point in time. Now, beginning to round this out a little bit with you, Tom, because we've covered a fair bit of the kind of the economic themes in terms of, at Drummond, with this in mind, and in recent months, what have you been doing with portfolios? Like, what does it mean for people and their investments, and what are some of the things that, I guess, the actions that you've been taking, you and your team?
Yeah, sure. So when the big backflip in interest rate policy happened in mid-December, so the US announced Jerome Powell to have another term as the chair of the Fed, and one of his first speeches after reconfirmation was that inflation was no longer transitory and needed to come under control. And essentially at that point, long-term interest rates really started to move. And so we were pretty swift through sort of December and January and really reducing interest rate sensitive investments from the portfolio, and raising sort of cash levels. And so in general, I'd say, we think this year is a period of adjustment to this new regime, digesting where inflation is going to end up, understanding, where the sort of terminal value for interest rates is going to be, and therefore what the right valuation is on equity markets, what we should be paying. So we've been doing everything with a sort of valuation sensitive lens, but in general, it's just the time to sort of play defense, not offense, try and, preserve capital through these markets. And then that way we can use volatility as our friend. When we do see big sell-offs like we've just seen recently, if we have a bit of cash that was built up through, when prices were higher, we're able to redeploy that. And that sort of buying into the weakness, it really sets up portfolios for good long-term returns from here. And so, that's a strategy we'll continue to employ, as we go forward this year.
Sure. And last question for you, perhaps a bit of general advice you can provide is, for those that are looking at markets that have taken this recent tumble, and maybe there's some more pain to come, no one knows with certainty, for those trying to time the bottom of markets, perhaps maybe some advice for those.
Look, picking tops and bottoms in markets is really difficult. Use the volatility as your friend. Make sure you've got a bit of cash always when markets are like this, because it's an optionality on buying things a bit cheaper. But in terms of where a potential bottom may lie, like what would cause us to become really bullish? Like at the moment, we're still playing defense. Like what would cause us to start playing offense and picking up some of those bargains and taking a bit more risk? Either the market goes, as I said, and prices in a recession. So either way, it's a buy, because it's either, as I said, going to happen and it's in the price, or it's not going to happen. Even better, there's a lot more upside. Or if we start to see inflation moderate. We think we're at peak inflation here, and so if that number starts to come down, interest rates continue to rise, and if the market discounts through lower prices a sort of recession, then largely all the bad news is captured in the price, and we think it will give central banks cover to either slow the pace of hiking, and at that point, whatever the level in the market is, we think that will be a sort of a time to find the floor. Does that make sense? And we haven't quite reached that point yet, but we think it's coming, and that's what we'll really be looking for, that sort of combination of factors.
Great. Well, I appreciate the explanation. Appreciate your time and your commentary today. It is helpful, I'm sure, to all the diverse clients out there watching this update. And to all of those clients, our clients, so many of the conversations we have around investment markets aren't around the tactics. We're not talking so much about, moving from developed markets to emerging markets and so on. It's more around conditioning for you for the inevitable corrections and downturns that are a part of everyone's investment journey. And it is those inevitable corrections and downturns where the decisions you make during those periods of time define your investing outcomes more than any other factor. And I know that sounds very simple, but that is absolutely the truth. And, it's times like these where if you are feeling a little bit nervous or worried, we're here, and you can reach out to your advisor and they'll make time very swiftly with you. But Tom, we appreciate your views on markets. It's been insightful. I'm looking forward to speaking with you again soon. Enjoy your weekend, and to our clients, enjoy your weekend. And we're looking forward to talking with you soon as well.
Thanks a lot, Corey.
Thank you. Cheers, Tom.